Okay, let's dive right into this. Welcome to today's Explainer, where we're stepping into the shoes of an expert investment analyst. Today, we are putting a massive industrial tech company through an absolute gauntlet of a stock analysis. We're going to completely strip away all that market hype and look purely at the cold hard numbers. And to do that, we're using the legendary frameworks of Warren Buffett, Peter Lynch, Benjamin Graham, along with some strict discounted cash flow modeling. Our subject today? AMETEK Inc., ticker symbol AME. So, is this a hidden gem, or is the market demanding way too high a premium? Let's find out.
Here's our roadmap for the analysis. We'll start with an AMETEK company snapshot, then view it through the Warren Buffett lens, followed by Peter Lynch and Benjamin Graham. After that, we'll run a discounted cash flow valuation, check out alternative valuation models, and finally, wrap it up with our synthesis and final recommendation.
All right, part 1, the AMETEK company snapshot. Let's establish exactly who we're dealing with.
Right now, AMETEK is trading at $237.76 per share. That gives it a truly massive market capitalization of $54.49 billion. If you're not super familiar with them, they're a leading global provider of industrial tech solutions. We're talking about manufacturing everything from highly specialized electronic instruments to incredibly complex electromechanical devices used in aerospace, defense, and the medical fields. They are, without a doubt, an absolute titan in their niche markets.
And honestly, operationally, they are firing on all cylinders. In their Q1 2026 results, they announced a fantastic 11% jump in sales to $1.93 billion, pulling in record GAAP earnings of $1.74 per diluted share. Their CEO, David Zapico, highlighted strong organic sales growth and really robust end market demand. All of that drove a record backlog of orders up 23%. So operationally, this company is a powerhouse. But as we all know in investing, a great company isn't always a great stock, right?
Let's move into part 2 and look at this through the Warren Buffett lens, focusing on economic moat and overall value.
When Warren Buffett evaluates a stock, he's hunting for a durable economic moat, consistent earnings, top-tier management, and low debt. Walking through his classic quality checklist, AMETEK looks pretty phenomenal. Do they have an economic moat? Absolutely. They're a global leader in highly specialized niche markets, which gives them incredible pricing power. Earnings consistency, that's a pass. They just posted record double-digit earnings growth. Buffett also loves a high return on equity, and AMETEK is sitting pretty at a very healthy 14.18%. And debt? Well, it's practically a non-issue here. With a debt-to-equity ratio of just 0.20, they easily pass Buffett's requirement for a strong, highly solvent balance sheet.
Buffett also looks really closely at owner earnings, which is basically the true cash a business generates for its owners after necessary capital expenditures. We can approximate this using AMETEK's free cash flow yield, which sits at a very solid 3.13%. That tells us they are a highly efficient cash generator. But here's the catch. Buffett demands a margin of safety. He wants a discount to intrinsic value. Trading at nearly 36 times earnings with a price-to-free cash flow ratio of 32, that margin of safety is absolutely zero. So Buffett's verdict here would undoubtedly be incredible company, but you gotta wait for a better price.
All right, section 3. Let's see what Peter Lynch and Benjamin Graham have to say, bringing in the GARP and deep value perspectives.
Under Peter Lynch's famous categorization, AMETEK is likely a stalwart or maybe even a fast grower given that double-digit earnings growth. But Lynch famously preferred stocks that Wall Street had completely ignored. He hated high institutional ownership. Now, what's really interesting here is that a whopping 87.43% of AMETEK stock is owned by institutions. For Lynch, this giant slice of the pie is a massive red flag. The secret is already out.
But the final nail in the coffin for Peter Lynch would actually be the PEG ratio. That's the price to earnings divided by the growth rate. Lynch insists on a PEG ratio of 1.0 or lower, which basically signifies you're paying a fair price for the growth you're getting. AMETEK, they have a PEG ratio of 3.26. That means investors are paying an enormous premium for future growth. Based on this alone, the Peter Lynch verdict is a definitive sell or avoid.
Okay, so if the growth guy says it's way too expensive, what does the strict value guy say? Benjamin Graham's defensive investor checklist is notoriously tough. AMETEK passes on adequate size and strong financial condition with a current ratio of 1.14. It also passes on a stable earnings and dividend record. They're currently paying a 34-cent quarterly dividend. But now for the valuation criteria. Graham wants a PE under 15. AMETEK is way up at 35.92. He wants a price to book under 1.5, and AMETEK is sitting near 5. It completely, utterly fails the value test.
Graham always brings it back to a hard, mathematical intrinsic value to ensure that crucial margin of safety. Given the sky-high multiples we just looked at, you have to ask, would Benjamin Graham even consider touching this stock at its current market price? Let's break down the math.
The secret sauce here is Graham's legendary intrinsic value formula. It multiplies 22.5 by the annualized earnings and the book value, and then takes the square root of the whole shebang. When you plug in AMETEK's numbers, that's $6.96 in earnings and $47.70 in book value, the intrinsic value comes out to just $86.44. Compare that to the current trading price of $237.76. There is no margin of safety here. We're talking about a massive margin of peril. Graham's verdict is a hard mathematical sell.
Let's move on to Section 4, our discounted cash flow valuation. Time to crunch some numbers ourselves.
So the legendary gurus all agree it's too expensive, but let's do our own quantitative heavy lifting here. To build our DCF base case, we have to make some educated assumptions. Step 1, we forecast future free cash flows using their current 3.13% free cash flow yield as our baseline. Step 2, we calculate a terminal value, assuming a standard 2.5% perpetual growth rate. That's a very reasonable assumption for a mature, successful industrial company. Step 3, we discount those future cash flows back to today using a 9% weighted average cost of capital, or WACC. That's a pretty standard industry assumption for a large-cap industrial stock with low debt like this one.
Because DCF models are highly sensitive to your assumptions, we always run a sensitivity table. Along the top, we vary our terminal growth rate, and down the side, we vary our discount rate. Now, even if we're super generous and assume a lower 8% cost of capital and a higher 3% growth rate, the absolute maximum value we get is $198. Our base case scenario, right smack in the middle, lands at a fair value of $150 per share. Once again, this is vastly lower than the $237 market price.
Let's quickly jump into Section 5, alternative valuation models, to see how things stack up against peers. We've got our DCF fair value, but as thorough analysts, we should corroborate our findings by looking at comparable alternative valuation multiples. If we run a comparable multiple analysis against the broader industrial sector, the overvaluation becomes even more stark. AMETEK's enterprise value to EBITDA ratio is over 23, its forward PE is nearly 29, and its trailing PE is almost 36. For a mature, industrial hardware manufacturer, even an exceptionally well-run one, these are basically software-level multiples. When you look at historical sector averages, these multiples imply an intrinsic fair value somewhere in the $130 to $160 range.
All right, we made it to Section 6, synthesis and our final recommendation.
We have officially run the gamut. We've heard from Buffett, Lynch, Graham, our own DCF model, and the market multiples. It's time to play the role of the judge and synthesize all this evidence into a final verdict. And honestly, this brilliantly illustrates the core problem with the stock right now. Graham's strict value is $86. Our DCF base case is $150. Comparable multiples suggest $130 to $160. Meanwhile, the current market price is floating all the way up at $237.76. Every single valuation framework is telling us the exact same story. The stock is priced for absolute perfection and then some.
But hey, we have to be balanced in our analysis. The strengths of AMETEK, the business, are completely undeniable. A record backlog up 23%, brilliant operating margins of almost 27%, and a literal fortress of a balance sheet with very little debt. The risk here doesn't lie in the business failing. No, the risk lies entirely in AMETEK, the stock. The extreme valuation multiples and the heavy institutional crowding mean that any slight misstep in future earnings could result in a really severe price correction.
So, here is our final verdict. If you already own AMETEK, it's a soft hold based purely on the phenomenal underlying quality of the business and its incredible compounding history. However, for new money, it is a definitive sell or avoid. It simply fails every single margin of safety test. To satisfy the legendary gurus and our DCF model, we would really need to see the stock drop significantly, down to that $150 range, before it triggers a justifiable buy rating.
All this analysis leaves us with a totally fascinating paradox to think about. AMETEK is arguably a flawless industrial company, executing perfectly, but is paying a massive, historically high premium for a flawless company ever truly a safe investment? Valuation always matters, guys, no matter how good the business actually is. Keep that in mind the next time you're evaluating your own portfolio. Thanks so much for joining me on this explainer, and keep learning.